Last time, we followed the money to the dollar's edge, to the challengers, and to the one question underneath them all. Could anything actually end the dollar's reign? You can argue about that forever. Or you can look at the one time it already happened, because the dollar was not the first currency to rule the world. Before it, there was another. It sat at the center of global trade and backed the world's reserves, and its home city was the financial capital of the planet. And then it fell. Not in a crash, not in a single terrible year. It fell slowly, over roughly 60 years, in a long string of quiet devaluations and one very public trip to a bailout. This is the story of how the British pound lost its crown, and it carries two lessons for the dollar. One should worry you. The other should calm you down. Because a reserve currency does not die the way the headlines imagine. It dies slowly, for structural reasons, and only when something is already waiting to take its place. Hold on to that. It is the whole story.
To understand a fall, you first have to see the height. Before the First World War, the British pound, sterling, was simply the world's money. On historians' best estimates, it was roughly half of all the official reserves the world's central banks held. The majority of global trade, by common estimates around 60%, was invoiced and settled in sterling. And London was not a financial center, it was the financial center, the place the whole system cleared through. There was even a name for the network it built, the Sterling Area, a block of countries, much of the British Empire and beyond, that held their reserves in pounds, pegged their money to it, and cleared their trade through London. If that sounds familiar, it should. It is almost exactly the role the dollar plays today. Sterling's dominance rested on four pillars: the world's largest trading empire, the deepest, most open capital market in London, gold convertibility, which meant trust, and network effects. Everyone used the pound because everyone else did. Because every single one of those pillars is what the dollar stands on now. That is why this story rhymes. So how does a currency that total ever fall? It begins the way almost every reserve currency decline begins, with war and with debt. The First World War shattered British finances. To pay for it, Britain sold off foreign assets and borrowed heavily, above all from one place, the United States, which lent it around $3.7 billion during the war. In the space of 4 years, the world's great creditor was turning into a debtor, and the debt lingered. By the mid-1930s, Britain still owed the United States more than $4 billion in war debt, and during the Depression, it defaulted. But the deeper shift was not the debt itself. It was what the war did to the two economies underneath. It drained Britain. It supercharged American industry and finance. Because the real foundation of any reserve currency is not tradition or prestige, it is the size and strength of the economy behind it. And that foundation had begun, quietly, to move west, across the Atlantic. The machinery of dominance was still running, but the first crack had opened, and it would not close.
After the war, Britain tried to reclaim the old order, a careful lesson in how defending the past can cost you the future. In 1925, the Chancellor of the Exchequer, Winston Churchill, returned Britain to the gold standard at sterling's pre-war value, $4.86 to the pound. The intention was to restore confidence, to signal the pound was as good as ever. But the pre-war rate no longer matched the post-war economy. At that value, sterling was priced roughly 10% too high. British exports became more expensive abroad, and they suffered for it. The economist John Maynard Keynes warned this would happen in an essay whose title said the quiet part out loud: The Economic Consequences of Mr. Churchill. 6 years later, the experiment ended. In 1931, amid a global financial run, Britain was forced off the gold standard, and the pound fell by about a quarter. And this matters because gold convertibility was one of those four pillars. It It was the trust leg. In 1931, in full public view, that leg cracked.
Then came a second war, and it finished what the first had started. The Second World War kept Britain solvent only through American support. First Lend-Lease, then, once the war was won, a large American loan of about $3.75 billion. The weight of that debt is easiest to feel through one date. Britain made its final repayment on that loan in December of 2006, 60 years later. And there was a second, stranger debt. To fund the war, Britain had borrowed enormously from its own empire, in its own currency, the so-called sterling balances, around £3.5 billion, held abroad by countries like India and Egypt. A mountain of your own money in foreign hands, whose holders might one day want it back. Against that backdrop, the new financial order was written. In 1944, at Bretton Woods, the world built a system anchored not on sterling, but on the dollar, convertible to gold at $35 an ounce. Every other currency, sterling included, was pegged to the dollar. The pound's rate was fixed at $4.03. The dollar was now the sun. Sterling was a planet. And almost at once, it was tested. A condition of the American loan forced Britain to make the pound freely convertible into dollars, and the result was immediate. A run drained the reserves so fast that convertibility had to be suspended after only a matter of weeks. The lesson was simple. You cannot promise to convert a currency your reserves cannot back. With the pound pegged to the dollar, its decline became a story of numbers grinding downward, a series of confidence crises, each one shaving value off the currency. The first big step came in 1949. Under pressure, Britain devalued the pound from $4.03 to $2.80, a cut of about 30% in a single move. For nearly 2 decades, Britain fought to hold that line and slowly lost. By 1967, it could not hold on any longer. The pound was devalued again, from $2.80 to $2.40, a cut of about 14%. What made that second devaluation memorable was not the number, but what was said about it. In a broadcast to the nation, Prime Minister Harold Wilson told the public that, quote, "The pound in your pocket has not been devalued." In a narrow sense, he was right. The coins in your hand were still the same coins. But the pound now bought less abroad. Imported goods cost more, and prices rose. And the gap between the reassurance and the receipt at the shop is the kind of thing people remember.
But one episode stands apart, because it exposed something no exchange rate can show you. Remember those sterling balances? The vast quantity of pounds held outside Britain? Britain's vulnerability was structural. Because so much of the world's sterling sat in other countries' hands, a loss of confidence could drain its reserves faster than it could ever rebuild them. In 1956, during the Suez crisis, that weakness was laid completely bare. As a political confrontation escalated, a run began on the pound. And the United States, a large holder of sterling and a gatekeeper to emergency lending, made clear it would not support the currency, signaling it could sell its holdings and withhold Britain's access to the International Monetary Fund. Britain's reserves could not withstand the pressure, and within days, it reversed course. Set the politics of that episode aside. The mechanism is the lesson, and it is the same one we traced last time with sanctions. Whoever holds your currency and whoever controls access to the system it runs on holds a lever over you. Reserve currency power is not only the power to spend, it is also the exposure to being leaned on.
By the 1970s, the long decline reached its lowest point. In 1976, the pound went into free fall, from around $2 in the spring to about $1.65 by the autumn. To stop the slide, Britain did the unthinkable. It went to the International Monetary Fund for a bailout, a loan of about $3.9 billion, the largest the fund had ever granted to that point. The chancellor, Dennis Healy, was reportedly at the airport about to fly abroad when the crisis forced him to turn back and manage it. And here is the honest nuance, because it matters. The crisis was real, but it was not bankruptcy. In the end, only about half of that loan was ever drawn, and it was repaid within a few years. Still, the symbolism was complete. The nation that had, within living memory, run the world's money was now standing in line at an international institution asking for help. 60 years after that first crack opened in the First World War, the slow death of a reserve currency was, for all practical purposes, done.
So now turn the mirror to the dollar. Here the honest answer splits in two. One half fact, one half genuine debate. Start with the fact, and it should unsettle anyone who thinks the dollar untouchable. By the best modern research, the dollar did not overtake sterling only after the Second World War. It had quietly caught it decades earlier, as early as the mid-1920s. The leading work finds the dollar passing sterling around 1924 in the reserve data and around 1929 in the bond markets. Older accounts put the hand over later, so even the timing is contested. But the lesson underneath is not. Incumbency is weaker than it looks. A reigning currency can be caught quietly, and for a time, two can share the throne. Now the numbers today, and they move, so treat them as of the latest reading. The dollar is about 57% of the world's official reserves, down from around 70% at the start of this century. A real, slow, multi-decade drift, but one that has never once fallen below half. And most of the share it has shed drifted not to a rival superpower, but into smaller, non-traditional currencies. That is diversification, not a takeover. The dollar does share some of sterling's diseases. It carries heavy debt. And, as we saw last time, every use of the dollar as a weapon gives the world one more reason to diversify. An emerging, partial, still debated effect, not a proven cause of decline. But the two things that actually killed the pound are missing. There was no war that turned America insolvent overnight. And this is the decisive one. There is no heir waiting. Sterling only fell because it fell into the arms of a currency that had already overtaken it. Today, no currency is ready to play that role. The euro is about a fifth of reserves, the yuan only around 2%, and neither combines the economic scale, the open markets, and the deep, trusted institutions the job demands. That is not a forecast. It is simply where the numbers stand right now.
So what does the pound actually teach the dollar? Not a date, not a countdown. The pound's real lesson is about structure, not the calendar. A reserve currency falls slowly, and for structural reasons. Economic decline, the weight of debt, crises of confidence, a slow erosion of trust. And it only completes that fall when an heir is already in place. Measured that way, the dollar shows some early strain, but nothing like sterling in 1976, and no successor stands ready to catch it. So the honest answer refuses both loud stories. It is not collapse. The base case among the economists who study this is a slow drift toward a world with no single king currency, not a crash. But it is not permanence either. Sterling itself fell slowly, and then suddenly. So the thing to watch is not a headline. It is the structure, the debt, the trust, and whether a real alternative ever assembles itself. One note, as always. This has been an educational analysis of how the monetary system works, not investment advice, and not a political verdict on any country. The figures are dated and sourced. Which leaves one question for next time. If the pound only fell because an heir was waiting, is anyone waiting now? Could the euro, the yuan, or gold actually be that successor? That is where we follow the money next. This has been Money and Power Explained. Follow the money. It always leads to power.